Welcome to the Yorkshire Shadow MPC, a partnership between Recognition PR, Clive Owen LLP and the York Press. Will the Bank of England resist raising interest rates in December? Along with the US Federal Reserve, the Bank of England and the European Central Bank opted to leave rates unchanged in their last policy meetings. The British Retail Consortium said this week that spending in its members' stores increased by 2.7%. Well, last year, at the same time, it had increased by 4.2%, but I suppose going up is still a positive. The UK's annual inflation rate fell sharply. It went down to 4.6% in October on the back of cheaper gas and electricity and, of course, petrol, its lowest level for 2 years. The November figure is due out later next week after the MPC meets. But what does all this data mean for interest rates? Let's see if our members think a further rise would be good for the regional economy in Yorkshire and their own sectors, and let's see if they think they're happy about the way forward. Let's firstly start with Gary Smith from Evelyn & Partners. You do personal financial advice and help investors invest their money, Gary. What is, from your point of view, the environment that you're investing in now?
It's more positive than it has been probably for the last 24 months. The markets have been looking for a definite sign that interest rate rises have paused, and it looks like when the November data came out that the markets now anticipate that we have reached the peak of interest rate rises both in the UK, Europe and the US, that inflation is now under control. And the speculation now, the markets now feel that the UK will probably go into a shallow recession, but unless the Bank of England reduce rates, that recession could deepen. So the markets are now anticipating that the UK Bank of England, when will they start reducing rates? Probably the back end of 2024, start of 2025. And that has seen equity markets around the world go up in value and also government debt. So fixed interest securities have started to rally as well. So we actually saw in November some portfolios going up 4% to 5% in a month. So it has had a positive impact. Hopefully that will continue. We did have the autumn statement, and we've seen that the national insurance reduction will come in from January. So it'll be interesting to see whether or not that will be inflationary or not. And we actually got further details on the changes to pension legislation that are coming in. But I think it's fair to say we are now in electioneering mode. So we'll have to see what policies will be introduced, if any, in the spring statement or when that election will be called.
One of the other consequences of the autumn statement, or maybe it was a consequence generally of inflation coming down, is that there are lower gilt yields. People who buy government debt aren't going to get as big a return, which means effectively long-term interest rates that the government pays have come down by about 0.5%. So that means the government will have a bit more room for either spending increases, tax cuts, or paying deficit down come March.
Yes, agreed. Yeah, so there does have a flip side. So gilt yields are directly linked to annuity rates. For those who have been retiring, annuity rates have been attractive for the past 12 months, but we are starting to see those fall. And certainly from a personal savings perspective, whilst you could have got in excess of 6% on a 1-year fixed rate bond in October, you're probably looking closer to 5.5%. So the direction of travel with interest rates, certainly from the bank's perspective, is that they will be coming down. Okay,
so you're saying coming down and stabilising or coming down, I suppose, if you are paying interest rates, is a good thing. Philippa Symington from Clive Owen, you obviously serve lots and lots of businesses in Yorkshire, and they all feed through into their accountants, and accountants have a great front row seat in what's happening in the economy. What's the takeaway you've got of the state of trade at the moment?
So I think it's one of those. I think it's that, the markets there's a big push on what will happen rather than what should happen. I think there's more and more debt that's maturing, which means that it's being replaced by a lot more expensive, higher cost debt. Because, unfortunately, during this period of time, because of the market as it is, people have cut costs, so they haven't had extra to spend on things like debt and making sure early repayment. So I think it's a very fine balance at the moment. People can see this shift in inflation, but you can see that there's an optimism, but a very, very, very cautious kind of look at it, because I think too many times in the past couple of years,
green shoots,
every time it gets optimistic, something else happens.
So you're seeing green shoots, but not a full flush growth.
Yes, very, very small green shoots.
Okay, well there we are. That's better than last time you reported in. But thank you, Philippa. All right, let's look at the job situation. I think Rob Lazenby's on from Castle Employment. What kind of assignments are you getting through the front door, and are you able to fill them?
Yeah, so I mean, overall, looking back at or through Q4 as we're seeing at the moment, I think we're continuing to see possibly a weaker economic outlook, and therefore there's quite a lot of caution, I would say, among businesses out there in terms of recruitment. So we have seen a slight fall in permanent staff appointments across the board, which is pretty much in line with what the REC are reporting as well. In terms, people are maybe having a bit of a reduction into hiring to finish 2023. Although that is meaning that we are seeing quite a lot of roles being pushed into early 2024. So they are still considering that, still looking at those opportunities within the business to expand and grow their team, but moving them into the first quarter of 2024 as opposed to finishing 2023. And in terms of candidates, we have seen a rise in availability of candidates at the moment, which I guess you could link that towards redundancies that we've seen across different sectors, and also maybe people's current job security, looking at the fact that there has been redundancies across businesses at the moment.
Do you think it's now a better balance than it was between candidates and vacancies? Because we've had Castle Employment on this before, and you've been pointing out, your colleagues and you, that there was a shortage of candidates, and that was one of the major issues.
Yeah, I think we, at certain levels, we still are seeing the availability of candidates on a lower level. So in terms of maybe across temporary billings and short-term assignments, we're still seeing a reduction in candidates, maybe at entry-level positions. But with redundancies and maybe job security being in people's minds, we have seen, or certainly have seen across some sectors, an increase in the availability of candidates at the moment as well.
Okay, well, Rob, thank you very much. We've had Rob, we've had Philippa, and we've had Gary, who've been all balanced, bit of good news, bit of bad news. I'm going to bring the whole tone down now. I'm going to go to Dave Broadbent from Begbie's Trainer. Dave, you look at insolvency, and we hope you're doing badly, but I suspect you're not. What's the kind of advice you're being asked for? What kind of problems are coming through the front door?
Yeah, unfortunately, you've hit the nail on the head. I'm glad Gary was the first person to mention the R word. I don't think we've had that on the talk for several months now, to be honest. But yeah, we are incredibly busy. November, generally one of our quietest months, but we have taken somewhere in the region of mid to late 30 appointments. I think the slight difference that we're seeing now is it's not the smaller businesses that are starting to struggle. It's picking up on the point that Philippa mentioned earlier. It's the funding side of it, whereas normally a director would come to see ourselves and we'd have to look at some sort of a recovery program for them, which could be effectively a buyback of the business. There's just not that funding there, and similarly as well, there's just not the appetite nor the amount of work out there as well. Certainly in the last 3 or 4 weeks, we've had to make several redundancies, which picks up on the point of what Rob was saying before. So it's as much as there are green shoots there, we're not seeing a huge amount of them at this moment in time. It is just getting more and more busier, unfortunately. I made the mistake of saying to my other half last week, I think it was, I kind of enjoy December, because December is a time when things quieten down for the insolvency world. Nobody obviously wants to close the doors on the run up to Christmas, but we are flat out at the moment. We are literally all working ridiculous hours. So if we are looking at the economy going into recession in the early part of next year, it's just going to make it a much more busier world for us, unfortunately.
I think it's very interesting to hear Gary and you using the word recession. I'm going to go to Steve next. Steve Lowe is, of course, from the publishers of the York Evening Press, which is an advertising business. My own business is in marketing and PR, and I think marketing, PR, advertising is at the front end of an economy. And before I ask Steve what he's seeing, I just tell you, in my business, I'm seeing a mixed bag. It's not all doom and gloom, but where it is doom and gloom, for instance, we've got customers in motor retail, it's where the general public are still picking up the lag effect of interest rate rises and maybe aren't going to make a big purchase like a motor car. But we've also had interesting inquiries through on construction, which is a long lead, where the interest rates are coming through as lower for the big financing of major projects. So very much a mixed picture, that the forward-thinking front end of the economy kind of things we're dealing with quite good. The customer focused back end of the economy stuff not so good. Steve Lowe, you're in advertising. People will want to display their ads for you in the newspaper or on your website. How's it doing?
Similar. We've got motor trade, property is slow. I think interest rates, the second-hand car market remains buoyant, where new car sales are less so, again, because of the interest rates behind. Retail is doing okay, but you'd expect it to at this time of year. And there's a real split for us across public and private sector. It's been well publicised that council debt is quite high at the moment, which impacts on their ability to spend not only in their marketing, but how it spends into the local economy, which impacts on people. So it's a bit of a mixed bag for us. What we're seeing is in York at the minute, very buoyant. You'd expect it to be. It's the middle of December. It'll be interesting what January is like when the Christmas trading has gone. So cautious, I think we would say we are at the moment, cautiously going into the new year.
So cautiously optimistic or cautiously pessimistic? We had Philippa being cautiously optimistic. What about you?
I'm cautiously pessimistic, unfortunately, because I think that the finances in the public sector are challenged, and I think that's going to flow through in lots of ways.
All right, thank you, Steve. I'm probably cautiously optimistic, but very much in the middle. Let's go to Bob Gammy from York Business School. He's the Dean of York Business School. Bob, see if you can pull some of these strings together. You're hearing from different sectors. What are you looking at when you analyse where the economy is for the Bank of England to consider rates?
It's interesting from a university perspective that our biggest factor, and the thing that we got to consider most at the moment, is not so much interest rates, as more the UKVI visa policy of the government as well, which has a hugely negative impact on our international recruitment. Students still want to come to the UK. Students still desperately keen to come to York, but being put off by the government in their policy and the way they're implementing their policy as well.
Because the new policy is they can't bring their families, really, isn't it?
Yeah, the postgraduate students can't bring their families anymore, and that has a massive impact. Plus, they put prices up of other things as well, so the cost of actually coming here has gone up. But the attractiveness of the UK for these students is still there, and so if the government wants to be more accommodating, then we could recruit much more students than we have. That has an impact on the university and a big employer in the city as well. And so I'm cautiously not optimistic about the way things are for us at the moment, and I think margins will be tight for us in the future. So it's a difficult trading scenario that we find ourselves in as well, and echoes much of what's been said around the room as well. I don't think there'll be any changes in interest rates or any changes at all from the government. So I think we will just trade on into the new year with exactly the same set of circumstances as we have largely, and I don't think UKVI visa policy is going to change. So I think universities are in for a very difficult time, and the ramifications of that for cities where they play a major role as huge employers there will have implications as well. So not very cheery.
I'm going to push you a bit outside of the university sector and look at the general economy sector. I'm going to invite Gary to comment on this as well, and then we'll go to Chris because it directly affects him. Of course, the Bank of England has to make a decision whether to put rates up, keep them as they are, or reduce them. But there is some evidence that inflation is remaining stubbornly high, and inflation is what they're supposed to target. The OBR forecast in the autumn statement said that inflation would be 2.8% by the end of next year. The Bank of England is saying that inflation will be 3.4% by the end of next year. Now, I know Rishi Sunak has said that he wanted it to halve, and he has had that, but the official target is 2%. Are these institutions to give up on the official target and just leave rates as they are, or should they pursue the official target, which might mean a slight increase and might mean a more dampening of the economy? Comment, Bob.
Yeah, well, nobody should give up on the target of 2%. It's there for a particular reason. We should stick with that, no matter what. But I do think it will remain stubbornly high, and I think interest rates will remain high as a consequence. CBI were saying they don't see a decrease in the interest rates until 2026, which seems to me slightly overly pessimistic. But we have to pursue this for long-term economic stability in the country. So that's okay. How I see it. No change in interest rates and inflation remaining stubbornly high. As it's interesting that the election fever is here for us. It'll be there's going to be something happening in regards to that, but I don't see much change at all.
Okay, Gary, just on this point, the intellectual point, Bob says you shouldn't give up on the 2%. He accepts where the rates are going to end up. There's other factors. Do you think we should change the 2%, or is it looking incredulous? You're going to miss this 2% target by 4 years, for 4 years in a row.
There has been talk about whether or not the target should be increased to 3%. The problem is, if the UK do that in isolation, it will weaken the pound and import inflation. So unless everybody does it, or the bulk of Western economies also increase their target, then it's sort of counterintuitive to put that target on. We are in the US. Their monthly increases are at 2%. So they are back down to that target.
They've hit the target.
We have food and fuel issues. One thing that hasn't been mentioned so far, one of the reasons for the fall was the worry was Iran would get involved in the Israeli conflict that's going on, and that would affect oil prices, but that hasn't happened so far, and we are seeing fuel coming down, but inflation will still be high next year. But as fixed rate mortgages come to an end, the average increase in the cost of mortgage borrowing is £500 a month. That will suck money out of the economy, and we will go into a deep recession unless the Bank of England reduce interest rates to stimulate people to buy. Inflation, yes, it will be sticky, but the Bank of England will be forced to reduce interest rates to stop a deep recession occurring.
Well, that last point is a good point to bring Chris White in from the Ecology Building Society. Chris, what are interest rates looking like on fixes now for you? Have they come down ever?
So I think market prices are coming down on fixed rates, and I think the average for 2-year deals was dropped below 6%, which is obviously positive for borrowers. I think Gary makes a good point around the fact that people that are coming to maturity are expecting to see an increase, and obviously that has an impact on the amount of money that people have in their pocket. And I think it's fair that, as an industry, we're concerned about people getting into difficulty on paying their mortgages, the cost of living prices and bank-based rates going up. But I think on the other hand, it's been a really positive news story over the last couple of years that savers have been able to get a better deal. So I think the point around inflation is a key one, that yes, whilst the rates come down to 4.6, I think underneath that headline rate, the underlying inflation is quite sticky, and I think the job isn't done there, and therefore I think reducing rates at this point would certainly be a bit early for me.
Chris, your mic's a little muffled. We didn't quite catch what your long-term rates were now. What kind of long-term rates could you get if you're going to fix for 4 or 5 years?
So if you're going to fix for what I was saying was that the average 2-year deal has come down below 6%.
2 years below 6%. Right, okay. Got that. One last point for you, Chris. I was surprised. There's been a lot of comment about rates and housing affordability and so on. the house prices in the latest big, I think it was Nationwide Building Society, a serious player building society, whether it's Nationwide or another, still saying that house prices are going up. I mean, that must be supply now, not the cost of finance.
So I think the fact that we've seen the trajectory for bank base rate flatten means that people have had a little bit more confidence in the market, and therefore we've seen a small uptick in HPI and house prices. I think the expectation that is in 2024 we will still see decreases, and I think that the expectation as well is that the volume of mortgage transactions in 2024 will be lower. So again, I think that is still an area of concern for the wider market.
Okay, we've reached that point where we're going to have our vote, folks. I get a vote today as well because we've not got our 9 on the system. So the first vote by show of hands. Who, if any, on the panel would reduce interest rates if they were on the real MPC this Thursday? No. Who on the panel, if any, if they were on the MPC this Thursday, would increase interest rates? None. And who on the panel, if they were on the MPC this Thursday, would tell the panel to keep interest rates where they are? Everyone, unanimous. And by the way, the similar MPC we do in the northeast of England with Clive Owen, the accountants LLP, Clive Owen LLP, has said the same. So everyone is going for freeze and hold. Thank you, everyone. Appreciate talking to you today. Some cautiously optimistic, some cautiously pessimistic, but I think the phrase mixed bag sums it up. Thank you very much.